So for the stock portion of your overall investments, you could have a collection of individual stocks, mutual funds, or exchange traded funds, or a combination of all these types of things. So we're going to look at each of them in turn. And most folks have a combination of these different types of vehicles, but you don't have to. You could have just stocks, just mutual funds, just ETFs. So let's take a look at that. So let's say you want to make a portfolio of just individual stocks, or what are the advantages of owning individual stocks versus, let's say, a mutual fund or ETF. So with individual stocks, you have more control. You get to decide when to sell and when to buy, of course, but when to sell stocks. So if you think about a mutual fund, you have maybe a fund manager, or maybe it's an index fund that's automatically buying and selling stocks to balance the index. The fund to the index, or if you have an active manager, like in a stock mutual fund where you have somebody actually making those decisions for you. You buy the mutual fund and they decide what they're going to buy, what they're going to sell, and when they're buying and when they're selling, and all of that. So you give up that control to get that diversification and that expertise. But they're making all the decisions, where if you buy an individual stock, you have all the control. You get to decide when you want to buy it, and you can decide when to sell it. Because of that, it makes individual stocks more tax efficient. Mutual funds are constantly buying and selling stocks. Some do more so than others. If you're looking at mutual fund, look at things around turnover. A higher turnover number, like 100% turnover, means they're essentially turning over all their stock holdings each year on an annual basis. So high turnover numbers is causing lots of buying and selling, which causes possibly tax implications. Now, a good active fund manager will try to balance what they sell versus what they buy and try to mitigate those tax things. But either way, they're making the decisions and they're incurring possible tax implications for you by that buying and selling. Otherwise known as churning too, where they're kind of constantly doing that to try to, drive, some great returns. Hopefully is what you're looking for them to do. If you own individual stocks, it can be much more tax efficient because you don't pay taxes on the stock until you sell the stock. If you buy it at this price, a low price, and you sell it at a higher price, that difference is your gain, or your capital gain, and that's what you're paying taxes on. But that only occurs for the capital gain portion when you sell the stock. So if you buy a stock here and you don't sell it for many years, or maybe for a long time, decades even, well, you're not incurring any taxes from a selling or a capital gain type thing. So I own some stocks, for example, that I've held for decades and more than decades, and they've really gone up in value, which means when I sell them, I'm going to have a big tax consequence. But by holding them, they'll continue to go in value. I think they're good stocks. They pay dividends. And so they're much more tax efficient, and I'm not incurring that cost now. In fact, those are some stocks I might pass on to my son or my heirs, that they can maybe, with some different tax vehicles, tax advantages, take advantage of that and have it become part of their own portfolio after I die. So I can put off that tax implication. Now, one thing about that, I'm talking about the gain, the price that you sell high and buy low, and that difference, that's your taxable gain in terms of tax efficiency. You can put that off. But many stocks pay dividends, or income type of stocks. They pay you a dividend, they pay you a quarterly dividend, and that's income coming into you. So that is basically potentially taxable income depending on where you live. In the United States, that would be taxable income. So either way, with individual stocks, because you have that control and how you can buy and sell when you want to, there can be much more tax efficient. Also, individual stocks are more targeted. You get to buy that individual stock. If you're buying a mutual fund, you're buying a basket of stocks. I've seen some mutual funds have as low as like 25, 30 stocks, and really, really concentrated, but you're still buying those 25 or 30 stocks. If you buy, let's say, like a Standard & Poor's 500 fund, well, you're buying 500 different types of stocks, or buying into that in different weighting or different percentage of those stocks, but you're buying all those stocks. But with buying individual stocks, you can buy that one particular company. Maybe there's a company that's really of interest to you, and you've done your research and maybe applied some of the things in this course as far as the fundamentals and the ratios and all the analysis that you're going to be learning. And then you're targeting more courses, targeting your stocks based on that. And that's a great thing. So you can be more targeted and build your own basket of stocks. Now, the downside, by buying individual stocks, you can be less diversified. I mean, you want to maybe get 15, 20, 30 types of stocks. Well, that's still a lot less stocks than, let's say, a portfolio that owns 500, or a mutual fund that owns 500 stocks, or maybe it's the entire stock market index that holds thousands of stocks. So you will have less diversification, which can be good if you want to be more concentrated in some areas, but it could be bad as far as having less diversification. When you're buying individual stocks, the onus is on you now to do your research, your due diligence, and to see, by picking those stocks. So apply the things and be more actively involved in your investing versus, say, picking a mutual fund and just letting it be. Maybe a real passive investor. Active and passive are good things depending what you're looking to do. But let's say I want to buy just an index fund and I want to have just the 500 largest stocks, or I want to buy an index fund that, or whatever I'm looking to do. I can buy that fund and kind of set it and forget it, and that mutual fund manager will make the decisions for me, or if it's an index fund, it'll track that index. It does it automatically. I don't have to do anything more. I just do my research, pick out the fund, and I'm done. Where with stocks, much more hands-on, I got to pick out the individual stocks from all these tens of thousands of stocks out there and pick the ones that I feel are the best for me and for my goals. And then once I pick those stocks, I got to track the results. I got to see how they're doing and what's happening in the industry and make changes as they go. Now, some stocks, especially like a dividend-paying stock, you might feel real comfortable buying and holding that forever, and it's going to pay you dividends along the way. But stocks go up and down, especially individual stocks are more volatile than a mutual fund of many stocks. So I have to track that much more closely. So if you have individual stocks in your portfolio, you want to really track that closely. And that's the same thing too. If you want to have an entire portfolio of just individual stocks, well, having 3 or 4 is so little diversification, it can be very, very risky to do that. Or putting all your eggs in one basket and buying one stock, or buying one company stock, maybe the employer you work for, that's really, really risky to do. So, most experts are saying 15 to 20. I think it's good 20 to 30. As far as all you have is individual stocks, you want to have that breadth across different industry sectors, different size of market cap, different types of organizations, large, medium, and small market cap, and maybe even have a variety of growth and income stocks too, depending, once again, on what your goals are. But if you have 10 or less, you're not getting the diversification you could really benefit from at least having 15, 20, or 30. And so to be more diversified, look at different industries, different sizes of organizations within those industries, and the style too. Is it growth, is it income, to build your overall portfolio. Now, a strategy I like around individual stocks is actually to kind of pair it with mutual funds, and in a setup where you have like a core of mutual funds and maybe some few core mutual funds that are your core things, and then have individual stocks kind of circulating around that core, so to speak, to round out your overall portfolio. So you have both a mixture of mutual funds and individual stocks. As we'll learn in the mutual fund area, there's advantages and disadvantages in mutual funds, so we'll look at that as well. But a good strategy to get you more diversification, get you a broader breadth of things, particularly in areas that you might not know as well or want to research more, or let somebody actually be more of the expert in that area, is maybe to get mutual funds in that area. A good core too might be some safer index mutual funds that are very low cost, so you're not paying a lot in fees, and to hold those, that can be your core, and then you build around that individual stocks. So one way you could do is, let's say 80% of your portfolio, of your stock portion of your overall portfolio that might have bonds and cash, but of your stock portion, maybe 80% of that's in mutual funds or an exchange traded fund, or something that's really maybe more low risk, and gives you that diversification by being invested in a lot of different areas. Maybe a total stock market index fund, or an S&P fund, or an international type fund, or maybe you have those core ones and then you add a couple other funds that might be more actively managed, maybe in a sector like energy or healthcare, where you want a more active manager, for example. Or you could go with an index in those areas too. There's different advantages of all those things, and we're going to learn about that within the mutual fund section. But the core is mutual funds, and then you add individual stocks around that core. So you don't have to worry about trying to track or buy 20 to 30 stocks and being on top of it and being pretty risky investment in just those small holdings. You can have that big core, and then around it, then buy individual stocks on things that you can maybe get a little bit of an extra return out of, because you might know those stocks are done really good research on a few stocks versus trying to build a whole portfolio of individual stocks. And that way you can really vary your holdings. It's a real advantage for individuals. You can have varied holdings. You maybe want to buy a couple healthcare stocks or whatever, something. Maybe it's something you have experience in a particular industry in, maybe an industry you work in or have worked in, or you just have a real strong interest in it. You can buy some individual stocks there and take advantage of some of those tax advantages where you don't have the distributions or tax consequences for mutual funds. You can really maybe buy and hold individual stocks for some time. And it can be challenging and fun. I mean, partake in this course is to learn to trade and buy stocks, whether it's a mutual fund or ETF. But part of this might be you want to do some with individual stocks. You'll have some knowledge to do that from the course, so put those things into play. And it can be challenging, it can be fun, but it's a little bit less challenging and maybe a lot less risky to have that core mutual funds and then maybe building up your individual stocks as you get more experience and as you try some new things. But you can always have that core of mutual funds. Remember, boring sometimes wins the race, right? You're not trading, you're not gambling. It's just kind of that investing. It can be a little boring, I guess, but I find it interesting. But it can be even more interesting if you're buying individual stocks. So that's one strategy you can do, one that I use, and it works very well. To have the core and then buy individual stocks around it. But you can buy just all mutual funds or just exchange traded funds as well. And we're going to talk about those next. So in the old days, many old days, all you could do is buy individual stocks. That's what you did. You built your portfolio and you bought individual stocks. But the financial industry, always looking for ways to sell more products actually, but also hopefully serve their customers too, came up with some ideas, and what was born was the mutual fund. We were basically mutually buying stocks together, almost like an investment club, but you're doing this with people you may have probably have never ever met. It could be from all over the world. So let's talk about what a mutual fund is so you have a good understanding of that and how it can maybe be used. So first off, and you might be very familiar with mutual funds already, but this is a good primer in case you aren't or want to refresher on that. So first off, a mutual fund is a pool of investors. It's me, it's you, it's people from other parts of the country, people from other parts of the world possibly, and we're all deciding to invest in this mutual fund. And by pooling all of our resources and our money together, and pooling it all together, we're able to share the risk and reward. We're basically hiring the mutual fund to manage those stocks, let's say in the stock mutual fund case, to manage that for us. And maybe that's an active manager who's buying and selling stocks and really managing, like we're hiring that person. Or maybe it's an index fund that's giving us some passive income and passive growth by following an index. Either way, they're managing that for us. We're not actually going out and buying stocks. We buy the mutual fund, and then the mutual fund takes care of that for us, and we share that risk and we share the reward as a pool of investors. The other advantage of aspect of a mutual fund is it diversifies the holdings. Sometimes within asset classes or across multiple asset classes, you could buy a mutual fund that's an asset allocation fund, for example, that buys stocks and bonds and cash and gold and all sorts of stuff. It could be that diversified. Or within a stock category, like we're interested in talking about here about stocks. So maybe I want to buy a mutual fund that just buys large cap stocks, or I want to buy a mutual fund that buys international stocks, and you can get even more specific, international small cap stocks, or stocks that pay dividends. You can get really, really finite as far as what you want to buy with a mutual fund. But either way, I'm getting a diversified amount of holdings. Now, the amount of holdings varies by mutual funds. I've seen some as low as 20 holdings, still more than maybe if I was buying individual stocks for most people. But still, it's 20 holdings, so it's more diversified, more things that could go up and less things that go down, so to speak, or as many as 500 or 600 or 1,000 types of holdings within there to get to even a broader amount of diversification. So a big advantage of the mutual fund is they're managing for you and they give you that diversification. You also get professional management, right? So you've got some folks, let's say it's a fund manager, a person who's in charge of the fund. They would have a team of people that work with them. And they're going out researching and they're selecting stocks and they're picking the best stocks for that fund is the idea. That's an active fund. So they're going out picking the best stocks for those funds. Or the manager might be just simply more of an administrator in an index fund where we're going to match this index, let's say like the S&P 500 index of large 500 United States stocks. But there's other indexes out there too. They basically just match that index as all they're doing is lower cost, and they're basically tracking that. Either way, you have professional management doing it on your behalf because you're part of the pool of investors. And lastly, with mutual funds, what they provide is liquidity, or the easy ability to buy and sell. Now, individual stocks are very liquid as well. You can go out and buy and sell them through an online broker or a financial planner, different ways that you can buy and sell individual stocks, the actual mechanics behind it. But a mutual fund does all that for you, buying and selling. But then if you want to get rid of the mutual fund or buy a new mutual fund or sell your mutual fund, it's very easy to do. It's basically, by the end of the closing day, it all kind of, equals up, so to speak, and then you can, sell that mutual fund. So if I own a mutual fund, and let's say that day I decide, hey, I want to sell that, I can go online typically and just click some buttons and I can sell that fund and it'll give me money in my account, or I can transfer it, I can sell that fund and do an exchange, what's called exchange, and then buy a new fund. All very easily. You can do it pretty much all online or through financial service firms as well, depending on where you have your funds. But the idea is it's very liquid. It's not like a house where it might take months to sell a house, maybe even longer than that. It can all happen within a day, basically, as far as selling mutual funds. So mutual funds, pool of investors, diversified holdings, you get some professional management and great liquidity. And it's a great product for people, particularly for newer investors or even experienced investors, to get those benefits very, very easily without having to build their own portfolio of just individual stocks. Okay, we understand mutual funds or pool of investors and all that, and give you some diversification. We talked about actively managed funds where you have a fund manager making decisions on buying and selling. You're basically hiring that fund manager to make decisions. So what are index funds? Where do index funds come? And what is the main advantages and disadvantages of index funds? And really where index funds came from was particularly from Bogle, who was a founder of Vanguard. So that's why Vanguard is so well known for index funds. Early start with that, and they do a great job. Is index funds mean you're trying to match the market. You're trying to match that index that's tracking a particular market or subset of a market. You're not trying to beat the market. You're just trying to match the market. You're trying to be average, so to speak. And the advantage of trying to be average is you can have some low costs and things associated with the fund itself that helps you to perform better than actively managed funds. And we'll get into that in the advantages and disadvantages in a second. So an index fund tracks a market, tracks an index. So a famous one I mentioned a couple times before is the S&P 500 fund, Standard & Poor's 500 index fund, the 500 largest United States market cap stocks. So if you want a fund that looks at large U.S. stocks, and it's an index and you want a broad diversification of 500 different stocks, well, maybe the S&P 500 stock fund is for you. By the same token, you could get indexes for different types of things and have funds that track that. Another popular index is the Russell 2000, which is the 2,000 smallest U.S. cap stocks. So if you don't want large cap, you don't want the big stocks, you want the small ones, maybe you're looking for growth and stuff, and you want a broad diversification, 2,000 stocks, well, you can get a Russell 2000 stock index that tracks the Russell 2000, or you can get index things that track a certain sector, like just energy stocks or just healthcare stocks, whatever it might be. You can have indexes that track virtually almost anything. And the idea is that you're trying to match the index. That's the whole key. It's very passive investing where you're not looking to buy and sell stuff. You don't have a fund manager who's actually actively doing that. You just basically have an administrative team that matches up the index, and if things change in the index, one stock leaves the index and a new one comes in, then they might buy and sell at that point to match the index. So their whole goal is to match the index and get better returns by matching the index. And let's take a look at how that works. So if we think about the advantages of index funds and why they're so very popular, is their low cost. When you own a mutual fund, you're incurring costs. You're incurring annual costs. We'll have a whole section on costs and understanding costs in mutual funds. But understand that by holding a mutual fund, you're incurring costs. Versus, let's say, an individual stock where you incur the cost of buying that stock and then selling that stock. Those are transaction costs. Mutual funds hold a bucket of stocks that they're constantly buying and selling within that. Now, an index fund has less of those transactions occurring within the fund. They have some, but they have a lot less. So their costs are lower from a transaction standpoint inside the fund. Also, you're not having to pay a team and some expensive folks to manage the fund, or a team of people to do research and all the stuff that goes into picking stocks at an expert level. You're basically just passively trying to match the index. So another way to reduce cost. And you have the potential within an index to have more diversification in terms of lots of different types of companies, because you can get, the Russell 2000, for example, is 2,000 small cap stocks. The bottom 2,000 of the Russell 3000, which is also U.S., which is all the stocks, or essentially all the stocks. So by getting those Russell 2000, the 2,000 smallest stocks, you don't have to pay somebody to research all those thousands of stocks and pick the best ones for a fund. You just match the index. And so with the low cost, what happens is if you have similar returns, or even if an actively managed fund actually does better than the index, which is rare, but let's say does better than the index, their expenses that are associated with it actually will bring it below the index. Also, they might have more tax implications with those actively managed funds too, thereby also reducing your potential return. So the idea is an index fund doesn't have to do as well to beat an actively managed fund. In fact, there's been all sorts of studies around about index funds and that they beat like 80% or more of their actively managed peers, and even more so over a longer period of time, because they don't have all that stuff going on. So something to very much look at, particularly if you're looking for a low-cost fund, something very much more safer, let's say, than maybe a very actively managed index fund or actively managed fund. So those are some of the advantages. So what are some disadvantages of an index fund? Because they have disadvantages too. Well, one is you have no fund manager. It's all administratively done. So you don't have a fund manager with a vested interest in it. In an actively managed fund, the fund manager gets paid on how well the fund does. And they get paid big money. These teams get paid big money to do well, to have their fund be the best actively managed fund or a top 20% actively managed fund. Index, you don't have that vested interest. You're basically trying to match the index. So you might lose out on a really strong fund manager or somebody who could consistently beat the index returns that it's matching up against and be a strong fund manager. It's hard to find them, but they're out there. So understand that you're giving up that as far as the fund manager. Also, if you're buying into an index, you might have a situation where the entire index is down, and so you're going down with that, for example, where a fund manager can actively sell out of something that might be going down and maybe buy something that's undervalued. If you're buying the index, you're fully vested in that index, and if it's going down, you're going down on that ride with it. Same idea as if it's going up, you're going up with it as well. It can be less diversified. Yeah, it can have a lot of holdings like the Russell 2000, of those small cap U.S. stocks, for example. But it can be less diversified and like, I'm just owning that. I don't own any international and I don't own large cap in that index fund. That doesn't mean I can't buy other index funds to give me that. I could buy an S&P 500, or I could buy an index fund for Japan or Europe or whatever. That might also help so you can build your portfolio around it. But each individual index fund itself is just, wouldn't be diversified with that type of thing that might be beyond the scope of that index. So something to be aware of. And they can be one also real tricky little thing to be really aware of, and really looking at the holdings within an index, is it can be heavily weighted in a few positions or a few stocks. For example, the S&P 500 fund, you think, oh, that's 500 stocks, it's 500 equal stocks. It's not. It's a weighted index, which means the bigger of the 500, the top 2, 3, 4, 5, 10, 20, have a much bigger impact than the other, let's say, 480 stocks in there. So things like Google and Apple and Johnson & Johnson and ExxonMobil have a bigger impact on that than maybe the 400th stock in there. And so you're really maybe a little bit more heavy in current times in technology stocks than you might have anticipated, because there's some big technology stocks in the S&P 500. Also, it might be something that's weighted if you have like a sector index fund. I saw a good example of that. Like if you look at the energy sector, for example, you could buy an index fund that tracks the energy sector, which sounds great. I get all these different types of energy companies, oil companies, gas companies, pipeline companies, people who build platforms for drilling, anything related to energy. Maybe even alternative energy is in there too, or is in there too, like solar power and wind power, and like, boy, that's great. I can have all this diversification in energy. Sounds good, but if you look closely at the holdings, there's a big chunk of it. It's like 20-30%. I think it's 20% of the holdings of the energy fund within, let's say, a Vanguard energy fund or the energy index, not Vanguard, but within the energy index, ExxonMobil dominates it because it's such a big company that 20% is ExxonMobil. So if you're looking to play more in that alternative energy space, for example, in wind farms and solar energy and all that, really what you're buying when you buy an energy index, you're buying a lot of ExxonMobil, a big oil company. So something to look at when you look at your indexes. So think of the indexes, think about what they're trying to, style-wise, what they're trying to accomplish, but then look at the holdings too to see if that's what you want and what you would like to have within your fund. And also because they carry lots of different types of stocks in there, there might be some stocks in a large index fund that you might not like. Maybe there's defense contractors in there, or tobacco companies, or alcohol companies. Where if you're buying individual stocks or you're buying individual fund managers, or even actively managed funds that are only buying stocks and things that are not related to what are called sin type things like gambling, defense, tobacco, alcohol, firearms, all that stuff. You can buy actively managed funds like that versus an index fund that's just going to kind of have this broad index. So index funds, some great advantages and very much in vogue versus actively managed funds, which have been struggling. If you look at the overall numbers, index funds historically have been consistently beating actively managed funds, but those few actively managed funds that do well might eke out a little bit better returns, but it's a lot harder to do with all the costs that they have on it. So now there's been a new hybrid that come out, which is ETFs, or exchange traded funds, which are kind of like index funds, but not really. So let's take a look at those. What has been really gaining in popularity is ETFs, or exchange traded funds. Either way, exchange traded fund or ETF, they mean the same thing. And the reason they're popular is they're similar to mutual funds. They're very similar, of course, to an index mutual fund, but they've got some aspects of individual stocks in it as well, too. It's kind of this weird hybrid thing that can give you some different types of advantages and disadvantages around it as well, too. So let's talk about exchange traded funds and kind of how they work. So first off, an exchange traded fund holds a basket of underlying assets, like a mutual fund, right? It's holding different things, maybe different stock or whatever, it might be bonds, whatever that exchange traded fund is tracking. But let's talk about it as a stock fund. Let's say it's a stock exchange traded fund, and it's tracking a particular index is what they do. And it's just like index funds. There's all sorts of choices as indexes, from tracking the NASDAQ to the New York Stock Exchange to S&P 500 to international markets to sectors, whatever. You can find exchange traded funds that do all sorts of stuff, and that they're tracking an index or tracking a basket of stocks. Typically is how that would work. So it's very much like an index fund, right? Pool of assets tracking an index. They also, like an index mutual fund, have a low expense ratio. It's not related to active buying and selling. It's tracking an exchange, right? It's tracking the stock exchange, or it's tracking the NASDAQ, or it's tracking the S&P 500. It's tracking something from an index aspect. But where the exchange part really comes in is it's traded on an exchange, like a stock, really. So this is where it's that hybrid of mutual fund and individual stock. If you buy a mutual fund, you buy it, maybe from your employer. If you've got a government-sponsored program, in the United States it'd be a 401k. You could buy it from your employer through that, or you buy mutual funds through a broker or a financial planner, or you can go right directly to company websites like Fidelity or Vanguard or T. Rowe Price or whoever, and go and buy mutual funds right directly from them. But you're buying it from some of these mutual funds that are outside the actual stock exchanges or markets. Because then what the mutual fund does, they go on the exchange and they buy the individual stocks that make up their index fund or make up their actively managed fund. Exchange traded funds track the index, but they're actually traded like a stock on a stock market exchange. And so you get the benefit of more quicker liquidity. You don't have to wait till the end of the day. It's basically selling right there. It's priced every day. Its price constantly is changing like a stock would be, versus, let's say, like a mutual fund, which has an NAV, or net asset value. Basically, at the end of the day, it all trues up, and you have a number that's your price you'd pay on a daily basis for a mutual fund, one time a day. Exchange traded funds trade throughout the day. So if the market's really crashing, you can buy and sell immediately, where a mutual fund you have to wait to the end of the day, and whatever its ending asset value is what you pay for it. So much more liquid with exchange traded funds. You pay a commission to a broker or whoever's transaction fee for buying and selling exchange traded funds, just like a stock. As part of that low cost in there too. And you can buy one share. There's no real minimums like you have with like mutual funds. One of the challenges of mutual funds is they might take thousands of dollars in many cases to invest in them. Some might have like a limit of $3,000 for some index funds. For example, some of the Vanguard funds, they typically start at $3,000. Or I know in Vanguard they have Admiral class, which is lower expenses even, but you got to have $10,000 to invest in it. Well, not everybody has $10,000 to invest, but they'd like to invest. An exchange traded fund will give you all those benefits of index mutual funds by buying one share at a time. So if you want to buy 30 shares of exchange traded fund, you could do that without having to come up with maybe thousands of dollars to buy a mutual fund. So exchange traded funds, for all those reasons, have been really growing in popularity as a way of building out your total portfolio. Remember, your stock portion of your portfolio is part of an overall portfolio that might have bonds and cash and other things in it. And then within that, you could have things like individual stocks, active mutual funds, index mutual funds, and now exchange traded funds as well too. And you can build your overall portfolio that meets your needs and really helps you get to your goals. But exchange traded funds, kind of that hybrid where it's like a stock, buy and sell, very liquid, you can buy at smaller quantities, but low cost as well too, and get you a wide variety of diversification as far as the holdings within the exchange traded fund. And they track their index just like an index fund would be. So exchange traded funds, check them out. One thing to look at and be aware of is a mutual fund style box. There's a term out there called style drift, where a mutual fund might say, we're a large cap value fund, right? A mutual fund might say that, and that might even be in their name. But then over time, maybe you have a new management team, or the management team, if it's an actively managed fund, decides to go a different direction. And so they're maybe investing, instead of large cap value funds, maybe they're, or value stocks, maybe they're investing more in mid cap type stocks or more mid cap growth. The style box will show you the current position of the fund, the Morningstar style box, and go to morningstar.com, put in mutual funds ticker symbol, or search by the quote for the mutual fund, and you can find a Morningstar style box. Also, mostly all mutual fund companies have the Morningstar style box or a similar box in the description of any of their mutual funds, because they want investors to know, this is what our investment philosophy is for this fund. So it's important to look at this, and let's take a moment to just kind of look at the box and understand what's going on here. And the idea behind it is you have these different buckets, right? You have 9 different spaces basically, and your fund fits into one of those buckets, at least partially in there. That's the idea of the fund. So for example, on the right-hand side, you have large, medium, and small. As we learned, that's large cap, medium cap, or small cap based on their market capitalization. So it doesn't necessarily follow 100%, but typically, let's say a large company like Apple or Amazon will be a large cap company, where a smaller startup that is publicly traded might be a small or mid cap type company as far as its market capitalization. So if you're interested in, let's say stocks like Apple and Amazon, you want to look for large cap stocks. Then along the bottom, it has things like value, blend, and growth. And as we know, growth is growth stocks, things that you want to have outperform the market from a capital appreciation. You want to buy low as far as the stock price. You want the stock price to grow and grow rapidly faster than the industry, the sector, and the greater market, hopefully. You want these to be high flyers, so those are growth stocks. Value stocks tend to be more of the well-established stocks, the players who might be paying more dividends, for example. It's not necessarily value from a value investing standpoint as far as a beaten down or contrarian stock or an underperforming stock. You could have that with the other ones, and sometimes that's called value investing. But with these style boxes, value might be a little bit more oriented towards income or dividend producing stocks, or stocks that are not growing as fast as other stocks, but might be great stocks for safer, longer term growth, and maybe pay a dividend as well, which could be a great investment. So we have those two ends, value and growth. Blend would be where a mutual fund is maybe buying both of those types of funds, or excuse me, both of those types of stocks in an overall blend of each of those. So for example, the S&P 500, the S&P 500 stock fund, or any S&P 500 stock fund, Vanguard is the most famous for that, but Fidelity, Schwab, everybody seems to have an S&P 500 fund. If you take the 500 largest United States stocks, which is what an S&P 500 fund is, you're going to have a mixture of growth stocks like Apple and Amazon, and value stocks, ones that pay dividends like maybe Coke or Johnson & Johnson. And you're going to have that mixture in those big 500 large companies. So that's where it would be a blend. So you basically have a matrix here, right? So if I'm looking for a large cap growth stock, maybe somebody like Google, a large big company, but I want it to really grow, and I think it's going to grow, or the mutual fund that's buying it thinks it's going to grow, it would fit in that large cap growth box. And that's, when you look at a mutual fund, if you're looking for stocks that fit that box, this box will help you this matrix will help you to select that. Versus, let's say if I'm interested in small stocks, I want to these newer companies, these just brand new, maybe publicly traded companies, these small companies, maybe a small high tech company, but I want it to be a real growth stock, or maybe it's a pharmaceutical or healthcare company that's small, but they got a wonder drug that's maybe coming. So they might be on the small side, but they might be really, really a growth type thing. So I'm looking for it to be a small growth type stock. Like I said, the blend stocks tend to be those mixtures, like a mid cap or a small cap or a large cap, where there's a blend of each of them, and value tends to be dividend or income producing stocks. So if I'm looking for, let's say, large dividend paying stocks, which typically larger companies or companies that pay dividends tend to be larger ones. They don't have to be, but tend to be. Well, then I might be in the large value box as far as a large dividend income producing stock. So the idea behind this, it helps me to select mutual funds or exchange traded funds that might meet my needs based on this style box, without having to go through a list of maybe 10s or 20s or hundreds of different types of stocks to try to figure out what it is. The Morningstar box does it for you and kind of says, this is this kind of box or this type of fund. And watch also for this style drift. Like if you're investing, looking for dividend paying value, large cap value dividend paying stocks, and it starts to drift to more of a blend, well, then you're picking up more growth stocks and less dividend stocks. So that might be not what you're looking to do because it's shifted. It's trying to move, away from that style box. Even though the name in the fund might say, the XYZ company, large dividend growth company fund, it might start to shift to be more of a, just the growth part versus, let's say, the income or the value part. So that's the Morningstar style box, or a style box for mutual funds. And when you're evaluating mutual funds, look at that. You'll find it in the portfolio sections of a mutual fund or in the holdings area if you're looking at mutual funds, and look at that style box and make sure that style box is meeting your needs as an investor. Otherwise, look at another investment that does. Let's talk about mutual fund expenses, because unfortunately, there's no such thing as a free lunch, right? Mutual funds do some great things. They give you a whole basket of holdings. They give you diversification. They give you less risk possibly. They give you a lot of good stuff, and you got to pay for that, at least somewhat. So it's real important to understand the mutual fund expenses, because that can make a big difference between mutual funds. You might be surprised to know that there can be a wide difference in terms of what mutual funds charge you to hold their fund, and it can be really impactful as far as your overall returns. In fact, that's why index funds have risen in popularity so much, and then exchange traded funds, which are similar to index funds, because their expenses are so low, they have a less big hurdle to overcome to have a good return when you're comparing, let's say, two funds. And after this lesson, the next lesson, we're actually going to look at a little case study where we're going to compare a couple of funds, and you can really see this in action and what the difference is between them when you start factoring in expenses and how impactful that can be. So let's start talking about, well, what are some of the expenses out there? What should I be looking for? Because a lot of times your expenses are kind of hidden. I wish it was a little bit more upfront. Some are better than others as far as mutual fund companies, but these are the expenses you want to be looking for. This is the overall expenses that are out there. And there's really two big ones that really you'll see everywhere, and you really want to be on these first, and then you look further onto the other ones. And the two big ones are sales charges, or loads, and the expense ratio. So let's talk about these first, then we'll look at the others. First off, sales charges, or a load, and that's usually how it's referred to as a fund might be a load fund or a no-load fund. And what does that mean? And the idea of a load or a sales charge is that's the privilege of you to buy that fund. So if I'm XYZ fund, I have this fund, I have these investments, you can buy into my fund, but to do that, you might have to pay to enter. It's kind of like a cover charge at a bar, I guess, right? You pay to get into the fund. And that would be called a front-end charge or front-end load. Now, a no-load fund would have no charges in front. So typically, like a front-end load might be around 3%, let's say, for example. So that means if you want to buy into my fund and I charge you a front-end load of 3%, immediately, whatever you invest, whatever amount you invest, I take 3% off the top before anything happens, before any returns or anything like that. That's like, thanks for the money. Thanks for the 3%, which is not insignificant. That's a big money. That means your portfolio, your investment in that mutual fund has already been reduced 3% forever. It's a one-time charge, by the way. It's not a recurring annual charge. It is a one-time charge. So that's the good news. The bad news is like it's taking that money right off the top, so you in fact have less money to invest in a front-end charge or front-end load. That's why a no-load fund that has no front-end charge, it takes zero of that, which means you've got more money working for you, and that'll help your overall return, because it's all about, not how much you make in terms of return, it's how much you keep. So things like expenses and taxes and some of these other considerations reduce how much you're keeping. So, please keep that in mind when you're looking at expenses. So front-end loads and front-end charges are all about taking money off the front right when you get in. Now, there's also what's out there called a back-end load or back-end sales charge. It could also be like 3%. So if you have a charge coming in, you may or may not, they actually have a charge as far as when you're leaving too, or as a back-end charge once you sell that mutual fund as well. So that can be real impactful. It's like, boy, I've grown up all this money, maybe invested for 10 years or so, and now when I cash out, they're going to take money away from me. Well, that's kind of icky, right? So when you're looking at mutual funds, and there's so many mutual funds, so many good mutual funds with no loads, either in the front or in the back end, really look at that first to see in your universe of mutual funds you want to be looking at, because that really is a big impactful expense either in the beginning or the end. So look for no load funds, I would recommend, but if you're looking at a load fund, it better be a top performer, a top 5, 10% performer, and well outperforming its index, because you could get an index fund with no load. So that's first thing to look at is sales charges or loads. The next thing that you want to look at is expense ratio when you're looking at expenses. Expense ratio, and they typically average like 1%, by the way, but some are very low, like 0.2 or even less, like in an index fund, and some are very high, like 2% or more. And an expense ratio is an average, is the average expenses that you incur, basically what you're going to be charged on an annual basis, okay? So like a front-end load or a sales charge is a one-time charge. Expense ratio is an every year charge. So if you're going to hold, let's say, a mutual fund for 10, 20, 30 years, you're going to have that charge recurring every year. So funds that have lower expense ratios make it easier for them to get you better returns and make it easier for you to make money. An expense ratio basically is pulling in things like the operating expenses of the fund, right? You have to pay things to actually operate the fund. So if it's an actively managed fund, I have somebody who's in charge of picking stocks, you got to pay the salaries of those people. In the index fund, you have people who are buying and selling, but it's all matching the index, so you don't have to pay as much or have as many people. Also, you have that might be wrapped up in there as a 12B1 fee or a marketing type fee that gets wrapped up in there. It might be separate from there or inside it, so you got to look at that too. But your expense ratio is what you're paying on that annual basis. So in terms of expense ratios, the lower the number, the better. Also, there might be additional charges out there, and we're going to look at a couple examples in the next lesson on where to find these things, but there might be some miscellaneous charges that are not part of the expense ratio. Sometimes that 12B1 or marketing fee, which is basically all that 12B1 is just extra expense, just charging for marketing, printing the brochures. It's just an extra expense. So look for funds that don't have a 12B1, but that could be outside the expense ratio, so watch for that. But also they might have some miscellaneous charges, such as might be called a custodial fee or some type of maintenance fee or some other type of hidden fee. You're looking for things that might be outside the expense ratio on an annual basis. But typically your expense ratio is going to have everything in there. But when you're looking at the funds, be aware that there might be additional fees on that. And they'll list them. They'll list them in the prospectus. They'll list them in their site, and we'll take a look and we'll show you kind of where that looks like. Lastly, there is possibly a redemption fee, very similar to the back-end load, where basically you have this fee when you sell. Now, a back-end load or a back-end sales charge means that no matter what, you're going to pay this fee at the end. So that's why it's called a sales charge or a load. You're going to pay a back-end at the end when you sell. Redemption fees are put in there to prevent like frequent trading of a particular mutual fund, where if you charge this fee if you sell before a certain time, like if you sell before like 30 days, for example, might be typical, or even 60 days. Most funds don't have this, by the way, but many do, particularly like a technology fund or a small cap type fund, where they don't want people to buy a fund and then sell it right away and then buy and sell. They're really trying to discourage market timing. They're trying to discourage active trading. And so they have this redemption fee that if you buy, that's great. And if you sell after 30 days, no problem. But if you sell before 30 days, we're going to charge you a fee, which would be like 1%. So they're really discouraging market timing. That's where like an exchange traded fund is a little different, where it sells on a market exchange. You can buy and sell throughout the day and still get that diversified portfolio. So when we're looking at index funds and exchange traded funds and actively traded funds. But from a fee standpoint, redemption fees are a one-time fee that occurs if you sell before a certain time period, typically 30, 60 days, versus let's say a back-end load where you're paying that 2, 3%, whatever it might be, no matter what. So just be aware if there's dates around when you're going to sell, if there's any kind of type of fee like a redemption fee. All right, so you can see there's a lot of different types of expenses, right? And there's a lot of different things that you can get charged for. So when you look at the performance of a fund or whatever, when you look at your choices for a mutual fund as an example, take fees into consideration, because that can eat away at your return, either right off the bat with a load or over time as an annual expense ratio. That's why companies like Vanguard is real famous for really keeping their fees down and really promoting that, because that's their niche. They want to try to drive costs down to get more return too. That's what they're doing with their index funds, versus maybe an actively traded fund that might say, yeah, we've got more fees, but our performance is so good because our people are so good, or whatever, our performance is so good, it's well worth it to you to pay maybe a little higher fee than a low-cost index fund. So those are different ways they market their funds, but for you, you want to look at it from an expense standpoint. Last big thought here on expenses too. Don't let expenses and things like tax consideration totally drive your whole investment philosophy. It's good to drive down those costs, and certainly it's worth it to look at no load funds and low expense funds without a doubt. But you don't want to preclude from maybe getting a better fund that might be a little higher in the expense ratio because they might be running a 3, 4, 5, 8, 10% better return, and you might just have to pay a little bit more in the expense ratio. So look at it as an overall return, but understand expenses can really, really eat away, and lower the expenses, the better off that is for you. Let's go look in the next lesson here, a couple case studies to look at a couple mutual funds side by side so I can show you where to find this expense information, because it can be hidden sometimes, and how to compare these, compare some funds together. So when you're looking at your own mutual funds or other types of investments, you can kind of get a feel for, hey, where do I find this stuff? Okay, so there's thousands of mutual funds out there, but let's compare a couple so you can really get a feel for these expenses and how to find them in their mutual funds and online, and their prospectuses, which a prospectus gives you the information about the fund in greater detail, and also how you can kind of compare and how to maybe evaluate funds from an expense standpoint. And we'll look at two here. We're going to look at the Vanguard S&P 500 fund, a real standard index fund, that low expense type fund, so you can get a feel what that looks like. And we're going to compare it to a Quaker Strategic Growth, a fund I happen to kind of find here to give you some examples of a fund that might have some loads and some different types of expenses, so you can get a feel for how they might differ on maybe both ends of the spectrum. So let's go take a look at these mutual funds and see what we see. Okay, we're over here at Vanguard. You can search Vanguard or Vanguard Group in the Google or whatever, and you might see a home page like this. They change them every once in a while. And I want to show you this because it's sometimes a little harder to find some of their mutual funds and things. You can also search by the name of the ticker symbol, might take you right directly there. But if you're looking at just wanting to look at their list of mutual funds, Vanguard's pretty popular. You just go under personal investors, and then you look under mutual funds. So we're going under investing and then mutual funds, because we're going to look up this Vanguard index type fund and kind of compare it to another fund. So we're going to browse index funds by class, because we're looking at a large cap U.S. stock thing, because we're going to compare this to Quaker. And really what we're looking to do is just to look at expenses. That's all we're looking to do, we're just going to look at the expense part. You can see Vanguard has money market funds and bond funds. They have a lot of different types of funds. So we're looking for stock funds, and we're looking for large cap. So here's stock funds, here's large cap. You can see they have different types, like dividend growth or growth index. Let's look at just the 500 index fund. This is their bigger fund, their Admiral fund, so it's a little bit more expensive again too, but at least you can get a feel for expenses and how it looks and differs. Whenever you're looking at mutual funds, you can kind of get a feel as far as different things to look for when you're going into the actual fund. And I'll show you a quick way to look up these expenses too at the end of this lesson, so you don't even have to go into the funds. But this, when we show you the quick way, you still want to know how to go deeper into the funds to find the kind of the small print, as they say. So if I pull up 500 Vanguard 500 index fund, it's the top. Admiral shares is the top 500 U.S. stocks, large cap. It gives you a little overview and all that. And what we're looking for is fees, because this lesson's on fees and expenses. So we're going to click on fees and minimums here. On other funds, it'll say like expenses or fees. Either way, that's what you're looking for, is expenses or fees. And overall, you can start seeing here Vanguard 500, real low. This is 0.05 expense ratio. Now you need like 10 grand to get in this fund. So it's not expensive to get into. The regular 500 funds like 3 grand to get into, and that's like a 0.18 or something. But it gives you a feel for how low the expense ratio can be with like an index fund compared to, let's say, the average of a little over 1% for funds. All right, so that's just the expense ratio. We want to know, is there any loads? It's like you can have a real low expense ratio, but if you have a 5% load or charge just to join the fund, well, that really eats away my return even if your expense ratio is low. This expense ratio being that annual cost. That's your yearly annual 0.05 you're paying. So we look down further here at fees. Purchase fee, that would be a load, is none. So great, there's no load to it. There's no redemption fee, so I could sell it after even only a couple weeks or whatever. I don't have to worry about holding it for a certain period. So there's no purchase fee or exit fee or redemption fee. There's no 12B1 fee or any other types of additional fees in there. If you had a certain account, like maybe in a certain type of trust account, they might charge you annually like $20. You'll find that when you go in to set up the actual account. But if we're just doing just investing regular old mutual funds, you can see, wow, this is extremely low, 0.05. A lot of mutual funds in the index category, you can find around 0.2 to 0.3 as far as a fund expense ratio annually. And heck, there's no annual fee. So if you like an index fund and low expenses, this is an example of a way to go. Let's compare that to the other extreme which is looking at a fund that's an actively managed fund that's got some pretty high expenses. And I chose this one intentionally just to show the idea of the expenses. And by the way, I'm not recommending one fund over another, though expenses and performance might be obvious with these two. But I just want to educate and show how you want to look at different funds. And this happens to be the Quaker Strategic Growth Fund. It is a large cap fund. It's a large growth fund, so it's a little bit more risky, a little bit more growth than maybe the S&P 500, which is growth and value, a little bit more of a blend, but they're still large cap funds. You can see they're not sharing too much with us right off the bat here. I wish they were sharing a little bit more here, but at least this is the Strategic Growth Fund here. Let's look at a lot of times you might go to like a brochure or a fact sheet. Brochures are all just sales, 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 so I like to go sometimes quickly to go to a fact sheet, but even fact sheets can be a little misleading, so you just got to be aware of that as well. So here we are in the Quaker Strategic Growth Fund. You can see they have different classes of shares, Class A, C, and I. I might be like an investor class where you can only buy that through maybe like a reseller, like a broker. And then they have different things like Class A and Class C, and they might vary based on their expenses and other requirements. A Class C might give you less expenses or maybe more, but they might have some other benefits to it. So let's take a look at this. And you can see the expense ratio here, just looking at their fact sheet, they have it right here, 2.24 versus a 2.99. You can see it's lower in the Class I, but you might need 40 grand to invest and you have to buy from a broker possibly. I didn't go through super detail on Quaker, but that's the idea behind the two. But still, we're at 2.2, 2.9, even 2%. That's pretty high, considering you got other funds that are less than 1%, even index funds are like in the 0.2, 0.3, 0.4 range. That's money you're paying every year. So every year, if you're in a Class C, you're going to pay 2.99 or 3%. You got to do better than 3% just to break even every year. So you can see how that impacts your return. And one thing I noticed here with Quaker that was a little I didn't like was sometimes you see these things where they show like a growth of $10,000, happens to be US, and they show, like, oh wow, this is Quaker versus the S&P 500 total return. The black is the Quaker and more the gray or brown is the S&P. And you look at it and say, look at Quaker, they're just kicking butt. Look how great they're doing. Well, the reality is this is since inception. This is not like the recent period. This is like since inception from 1996. So maybe back in 1996 it was a good fund, and because you had that good fund for all those years, it's still maintained it. But how is it done recently? Because that's what we care about, is a little bit more recent, because they might have changed a fund manager or something. So this is not the expense part, but just to give you a feel for it, you can kind of see here when they show returns, like average annual returns. Well, before sales charges, 7.5, but you have these sales charges we're going to talk about in a second. And otherwise, you're at 6.36 after the sales charges over the last 5 years. Compared in this period, compared to like 12% for just a plain old vanilla index fund for the S&P 500, right? I mean, it's getting crushed over the last, last 10 years, right? Versus inception, it does great. So I was a little deceptive on that. I didn't really like that. But we're looking at expenses here. So what do we know so far? Well, we know Class A and Class C shares, they run a 2.2 or 2.9 expense ratio. That's really high. Let's just talk about that's really high. All right, so now we want to know, is there a load? Is there a before charge? Because a lot of times when you have these kind of funds, they might have a fee or a charge in there. And there's more information here. They give you some things around what their holdings are and stuff. But I'm not seeing anything here on this short little fact sheet about loads or other expenses. It's just a short little fact sheet that just gave me some quick information, which is nice. I can look at this right now and say, at a 3% expense ratio, it better be crushing the index, and it doesn't, so that might be kind of worrisome. So what do, right? So you got this quick kind of like fact sheet. Well, the next thing you can do is go into the prospectus. That's really where you find all your detail on funds, on mutual funds, is the prospectus. You can see they don't even have a link for it here. You got to go up here, and then you find like this big prospectus with all their funds, and you got to kind of scroll through to find the fund you're looking for. So in the interest of time, because it was kind of icky, I already did that. And so here's from the prospectus, the Quaker Strategic Growth Fund, and this is going to give you a little bit more detail on a lot of areas, in particular like your expenses. So let's see if we can find the sales charge here. Let me blow this up a little bit, and why, yes it is. It's right here. You see where it says maximum sales charge or load imposed on purchases as a percentage of the offering price. So they're obvious, they're honest, they're saying this is what it is. And with Class A shares, it's 5.5%. Holy moly, 5.5% just to get in the door? That's pretty high. Now, Class C, an institution where you might have, have bigger things or bigger things you can do, then you have to have more money invested. In fact, it says up here, if you and your family invest or agree to invest in the future at least $50,000 in Quaker funds, you might get a reduction on your sales charge. You might, So if I give you $50,000, maybe I don't have to pay 5.5%. Maybe I can get something a little less. And maybe if it's $100,000, I can get a Class C share. A little more details behind that. But either way, that's pretty high. But even if I was a Class C share, you can see these are the management fees, 1.3. They break down the fees, and there's 12B1 fees. So these are extra fees that are wrapped up in your expense ratio. These are your annual expenses. They got some other stuff here. They got fund operating expenses. They got all sorts of stuff in here. The bottom line is that you're going to pay 2.24 or 2.99, depending on the class of share you're buying, every year just to hold that. So if I bought, I'm just a regular guy investor, and I bought a Class A share, I'm going to pay 5.5% just to buy the fund. And then every year, I'm going to get charged 2.2% on my holdings every year. Compare that to a no-load fund that's zero and might be less than 1% as far as, or average is 1% for even actively managed funds and less for index funds. And you can see then that makes it hard for a company like Quaker and their Quaker Strategic Growth Fund to do well. They're really making their money on the fees that they charge is really where that's coming in. So if I was evaluating mutual funds, I would have some concerns about Quaker, and I'd certainly expect some big, returns from them. Okay, so we've dove into these funds and dove into things, pretty deeply, and that's what you want to do. Go in the prospectus and really get deep. But let's say I just want to find information fast. In Google Finance, Yahoo Finance, a lot of places have this. I think I like the Google Finances for finding out expense things, or can find it real quick, and you can just put in the different ticker symbols around that. So I know, or you could just type in the name. So if you're not sure, what you're looking for, you could go into, let's say, Vanguard, and it will pull up all the Vanguard funds, and the more you type it in. In fact, let's look at the Vanguard regular old 500 index, the investor class. We were looking at Admiral, which had super low expense ratios, but you needed 10 grand. This one you don't need as much in. You need like 3 grand, but at least gives you an idea of something, a standard type of fund. Pulls up the current price and all that, but what we're looking for off to the right-hand side here is where we'll find our different expense ratios and expense information in there. And that's what we're really looking for is there a load? Just if I'm looking quickly without going to a prospectus or really trying to search for all these different funds, I can go right in here into Google Finance, just by going to Google and then Finance or just searching it. I can look up the company name, the mutual fund, this is the Vanguard Index, and you can see here, front-end load is 0, deferred load, that would be your back-end load or back-end sales charge, that's 0, and expense ratio of 0.16 for this one, the investor classes versus their Admiral class where you had to put more money in. So I can see, and there's no management fees or anything, so I can see, no loads, real low expenses, index fund, that's how they do it. Let's compare now to Quaker. You can see how quickly we're able to get this information now. So if we put in Quaker, and if I know Quaker's symbol, but if I didn't, I can just type in Quaker, and I can find their Quaker Strategic Growth, right? We were looking at that A shares, right? That had the big front end load. Let's look at that. So there's Quaker, and I can scroll down, and I can see right off to the side here, front end load of 5.5% and expense ratio, the overall expense ratio, not broken down, but overall 2.24. It's all loaded in there. There's no deferred load, no back end charge, no extra management fees, but you don't have to worry about that. I'm getting 2.24 every year on that. And it's interesting, under their total assets, they've got 85 million, a little over 85 million in assets, so somebody's investing in them. I'm not sure it would be me, but these are the people who are putting in big bucks to try to avoid some of these charges and these loads. But for us regular investors, that's a pretty hefty number. So yeah, that's where Google Finance is nice. You can just type in the ticker symbol. The ticker symbol is right here. That's like the thing you can look up as far as quickly looking up stock if you know a ticker symbol. If not, just type in the name and you'll be able to find it in there.